Good evening, ladies and gentlemen. Welcome to today's call. I am Sankalp. I represent PMS AIF World. And, if you have been following us or have keenly watching this space, I'm sure you would have heard of us and what we do. At the risk of being redundant, I'll repeat a little bit about us. We are determined to create an ecosystem of informed investing where investors do not just look at the few popular products, but or the few popular names of investment manager, or are not too spellbound by that, but go actually at merit. We do a keen analysis of 5 factors, which we call the 5P analysis, which covers people, philosophy, portfolio, performance, and price of portfolios. And what this does is it throws up, or it brings to us, a lot of interesting fund managers, a lot of interesting portfolio. And in that virtue and in that spirit, today we have amongst us a very, very special guest, Mr. Sachin Shah, who is the fund manager at Emkay Investment Managers. And let me just take a minute to give you a little background of Mr. Sachin. As you were discussing before the call, Mr. Sachin is, has a rich experience of almost 2.5 decades in the Indian capital markets. Mr. Sachin has, he likes to call himself a keen learner, and that is what I like about him. And he has been associated, or he has worked previously with with few of the best in the investing, world in India, ranging from Nirmal Jain, who started Probity research, back in the days. Before IFL was actually the nomenclature. Then he worked with one of India's most well-known investors, Mr. Ramdev Agarwal at Motilal Oswal. Then he moved to MK, where he's been associated with them for 9.5 years almost, right, Sachin?
Yeah.
So he has this unique, framework or unique philosophy called E-Qual, which E/quality, which I'm hoping we will get to know a little bit more on the call. So that is a little bit about Mr. Sachin. I hope I've not missed anything important. A little bit about MK. So, MK has been, it's one of the well-known, investment or financial services house in the country. On their asset management side, today they manage close to 550 crore across PMSs and AIF, and they've been here for 25 years now. Their AIF, which has performed really well over the last one year, and whatever the duration that it has been, has beaten most of its benchmark. Their PMSs also have done well, and interestingly, their PMS is also called lead. So I think it has led in terms of returns also. So I'll not hold the audience any further, and I'll hand over the stage to Mr. Shah, who can take us through his philosophy today. And we will be very happy to take questions as we progress. Thank you. Over to you, Mr. Sachin.
Thank you, Sankal. Thank you so much. Good evening, everyone. It's thank you so much for being with us. It's indeed a pleasure and a privilege to be part of today's presentation along with PMS AIF World. Let me just load my presentation in a second. Yeah, so what I'm going to talk today about is some of the investments that we have done in the last few years. How did we catch some of those investment trends? What has been our thought process? What has been our investment philosophy? And when we invest in those businesses, what is also important is how do those businesses will create wealth, and that to sustainable wealth, because if we want the compounding gain, it has to be a sustainable wealth. So I strongly believe that we need to have a construct that every business needs to be, each of those parameters need to be there in those businesses for them to generate wealth. And then, of course, identifying those investment trends will always help us a lot, accelerate our returns or to do a little better than the overall economy. So I will walk you through first to the business construct. And once we create that base, because I believe creating a base is very important. And then from there on, I will talk about the investment trends that we have invested in. I will be more, in fact, I will be giving quite a few examples specific to sectors, specific to companies, and how did or why do we like those businesses, why do we like those sectors, and why did we select them over some of the other conventional investment trends. So let's start with the business construct. So, when I talk about the construct for the businesses that is required or that is pertinent to generate wealth, I think the first thing that is very important is to look at the track record. So when we talk about the track record, it's all about looking at the historical numbers. And of course, when we talk about financial investing, it's also always about profit and loss, balance sheet, cash flows, because numbers speak a lot. Numbers tell us what has gone through in the last few years. How did the company manage itself during the good times, during the bad times? All of that comes, in front of us. Now, what I have done here is I have mentioned in the order that we like to see, how these numbers we look at. So, for example, when I'm looking at P&L, now P&L is actually just one particular period. It could be for 1 year, it could be for say 1 quarter, or say for half a year, but that's where it ends. When we look at balance sheet, it's a cumulative of last many years. And every business goes through a good and a bad cycle. How did that business manage itself during a bad cycle will actually get reflected in a balance sheet. But even with balance sheet, as somebody rightly said, what it reveals is interesting, but what it conceals is much more exciting, right? So even in balance sheet, there can be a few hidden things. So for us, the most important thing is actually cash flows, because we strongly believe that cash flows do not lie. It's very, very difficult to manipulate cash flows. And if you look at in a block of 3, 4, 5 years cumulative cash flows, it's even more difficult to manipulate those cash flows. Of course, I agree that there will be certain exceptions, but they are truly, truly outliers. In my so many years of experience, at least in the Indian context, there are, you can count on your fingertips how many companies can have done something wrong on the cash flow side. So this is something that we never miss. Cash flows is something that we are very, very cognizant about, and we pay a lot of attention to it. So in that sense, track record is very, very important for us. The second important thing is the business scalability. Now, this is where it's very, very essential to understand your landscape, because, actually, if you think about it, India is a very large country with such a large population. For everything, there is going to be a large opportunity. But within those segments, how large can it be for you? Or can you actually even increase your landscape? Like, for example, if you look at, say, the pharma industry. Now, the domestic formulation industry is about rupees 1.5 lakh crores, so it's about $20 billion. Now, if we think that can the Indian pharma industry also cater to the world markets? So if you just take the generics market, it just multiplies the entire opportunity, right? And in fact, actually today, if you see the construct of the Indian pharma industry, $20 billion of revenue does come from the domestic formulations, but another $20 billion, which is equal size, comes from the generics market, the global generics market, which makes it $40 billion. And if I include some of the other businesses like the CDMOs and the CRAMs, that will be probably another $5 to $10 billion. So it's about almost $50 billion, which is only a $20 billion size. So because the growth of the whole idea about growth will be dependent on the kind of the opportunity which is there. The other thing also very important is in terms of understanding the scalability is the industry structure, right? How fragmented the industry. The more the fragmented, a little more difficult it is. But there are certain industries which are very, very consolidated already. For example, if you look at the auto industry, now every segment within the auto industry, it could be passenger vehicles, it could be two-wheelers, it could be commercial vehicles. The top 2 players or maximum the top 3 players will actually have about 70-80% market share. So it's much more easier for us to decide on how do we invest in those businesses, because where are they headed? It's much easier. Like, for example, telecom industry, for last so many years now, we've seen the consolidation phase happening. And now it's almost boiled down to 3 players and probably 2 players over a period of next 1 or 2 years. So, it's much easier then to make an investment call over there. The third, which is the inherent profitability, which is about the ROCE and ROE percentages. Now, all of us know that return on capital employed and return on equity as a percentage is very important and critical, because how much did I invest and how much did I earn is something what we all like to know, and we all like to have it higher and higher. But I think it's much more than that. The way I look at it is that this is actually the fuel for growth. We all talk about growth, and growth, but to capitalize that growth, the opportunity size is very large, industry structure is good, but how does one capitalize on that growth? Because every company will have to actually reinvest a lot of money in the business to take it to the next level. Now, for that to happen, you need to have your own internal accruals, and that's only possible if you have higher profits, higher ROCs, because that is truly your fuel for the next level of growth. So to my mind, this ROC and ROE are actually they play a very big catalyst role in creating a very strong base for the next few years of growth. Now, the management quality. Now, how much ever I emphasize on this, I think it's going to be less. Because if one looks at most of the companies that have created wealth in the last few years, I think the entire credit goes to management quality, because there is opportunity size, there is a decent industry structure, but only a few of them are able to capitalize on it. So many times we come across where managements are honest, but we don't find them capable. If they're capable, we don't find them honest. If they're honest and capable, they don't have the larger vision picture. They always miss the bigger picture. So that's where your integrity, which is the honesty, comes into play, which is the strategy, having a bigger picture in front of you, or able to see, and having the vision is very important, and flawless execution. I think that's very, very critical. Executing to the T is something so important. Because we have seen so many managements where they are very honest, they have a good thought process, but they falter on the execution side. And, as you would have seen in my picture here, I very deliberately put it in a pyramid format, where I'm really saying that what is the importance of each of these parameters. And I think management quality comes at the top of it. But when it comes to equity investing, see, these 4 parameters are about how does the business generate wealth, how does the business create, how does the business go to the next level, how does it create its own scale, its own size, its higher profits, right? But when it comes to equity investing, I think there is one more very important point, and that is the purchase price discipline. At what price do I invest in that stock? Because, it's all this is all great, but if I have bought it at a wrong price, of course, first is you can't buy companies which do not tick the first 4. And then it's very important to have the right purchase price. And let me tell you one thing, in my so many years of experience, there is, investing is actually about science and art. And this valuation, which is the purchase price, is a lot to do with art. For example, if I look at number 1, number 2, number 3, a lot of it is science. We all have a lot of data. We can put it in a very structured format, and we can decide this is eligible, this is not eligible. We can do all of that. I think management quality is a combination, evaluating management quality is a combination of art and science. But when it comes to valuation, a large part of it is art. Let me give you a small example of it. In the year 2000, Infosys did a profit of about 300 crores. And in the year 2014, that company's profit grew to rupees 10,000 crores, which is 30x in 14 years, which effectively means more than 25% compounded, actually almost 27% compounded growth rate over 14 years. Now, if you think about Infosys is the best company, and at that point in time, TCS wasn't listed, so Infosys was the number 1 company, the biggest IT company in that sense. It had the opportunity size was the same for all the other IT companies also. But barring the top 2, 3, or 4 companies, most of them were not able to scale up the way Infosys or a couple of them have been able to do it, right? So, it was the best company. they had the right opportunity size. Their ROCs at that point in time were very high, almost 40-50%. In terms of integrity, and I think integrity is not only to wealth, to the shareholders, but integrity towards your clients, integrity towards your employees, integrity towards your partners, integrity with your shareholders. All the stakes were there. Strategy-wise, they never missed the bigger picture and flawless execution. Because unless these three would have fallen in place, for Infosys to grow from 300 crores of profit to rupees 10,000 crores, today there are probably less than 10 companies. In 2014, there were less than 5 companies which made a profit of more than 10,000 crores in the Indian context. Today also, I think there will be less than 10 companies. So unless all of that would have fallen in place in a big way, I don't think Infosys would have reached that level. So all the ticks are absolutely in there. But let me tell you an interesting point there. An investor who invested money in Infosys thinking that it will grow to 10,000 crores of profit in 2014, and obviously if you're growing at 25-27% compounded rate in terms of profit, you definitely expect that you should make that kind of money. But the investor who invested money in 2000 probably made in 2014 mid-single digit return, maybe 6-7%, which is probably similar or even below than the bank fixed deposit rate that was prevailing at that point in time, right? So the only problem was that you bought it at a wrong valuation, in spite of you getting it all right. And this is Infosys. Had you bought any other IT stock in those heydays, even today after 20 years, you would have lost 60, 70, 80% of the money. So buying the right purchase price, I think it's a very, very important element when it comes to equity investing. So this is all very, very pertinent. There is no doubt about it. And I would say that this construct has to be always in your background when we are trying to look at investment trends. But is it enough? That's the question. That's the real question, right? So from that perspective, what I would like to say is that every business goes through a good and a bad cycle. The question is, where we invest our money, does it have do those business have tailwinds? We need to really catch those tailwinds where the businesses are able to grow a little faster than the GDP growth. They have certain catalysts which are going to come into the play. And that is where I talk about, swim with the current, right? And this construct for the businesses that generate wealth will be my principles, where I would not like to compromise on them. Now, finding investment trends and then finding companies within those investment trends along with this business construct is something which is how we work out here. Yeah, so now if we look at one of the trends that we invested in the last 4 or 5 years, or actually the last 2-3 years, but let me get back, let me take you to about 3 or 4 years back. So sometime here around 2013, 14, 15, 16, the Indian pharma markets actually did quite well. And, a large part of that growth came from the US generics market. Now, when I talk about the US generics market, what happened in sometime around 2015-16 is that the buyer side had a lot of consolidation. So in the sense that the entire 80 to 90% of the market now is controlled by only 3 or 4 buyers in the US. Now, when that happens, the bargaining power of the sellers, which is the generic manufacturers, has got diluted quite significantly. And that continues even today for last 4 years. So clearly there is going to be some impact on the profitability. On one side, you have more and more suppliers. There are more and more companies who are getting into the generic space, not only from India, but from a lot of other countries like Israel and many other places. At the same time, your buyers have got consolidated. So now you have only 2 or 3 people who you have to bargain with. And obviously they have the higher bargaining power. So what we did is we started focusing on few other segments in the pharma almost 3 years back. Or actually DV's lab is one thing that we invested more than 5 or 6 years back, which is the CRAM space, the contract research and manufacturing space, the CDMO space. Now, if you think about the CDMO space, what is the opportunity size? What is the business scalability over there? In terms of business scalability, it's almost $100 billion market at this point in time. Most of the large pharma companies are growing their R&D budgets at the rate of about 3 to 5%. But what they outsource is much more than what they are spending every year. So the outsourcing market, which is the contract research and the manufacture or the CDMO market, is growing at about 5 to 7% every year on a $100 billion market. Today, I think most of the large global pharma companies actually outsource nearly 25% of their R&D budgets. In fact, most of the biotech companies are actually outsourcing their entire 100%. So that's the size of the opportunity that we see. There are very high entry barriers because these are very high sensitive IP related businesses, because when a large pharma company, if they're doing some R&D work, they want to, these are like intellectually property, which they would like to keep it as much secret as possible. And from that perspective, these companies have to gain a lot of confidence from these global pharma companies. And because the entry barriers are high, the profitability is also high. So companies which were Divi's Lab, Suven Pharma, Laurus Labs, in this CRAMS business, they all make about 25, 30, 40% kind of profits, on a continuous basis. So that also takes into the inherent profitability of the tick boxes that we like to have a look at. The other thing is, in terms of the management quality, if you look at Divi's Lab, they have been around for almost now 15, 20 years. And generally whenever we invest, it's not that we would have just looked at that company as on yesterday or day before yesterday. We would have observed that management, we would have observed their strategy, we would have observed their actions. And we have a very special module about E-Qual risk on our proprietary side, which is what we use to scan all these companies. Because a lot of companies will talk a lot of things, but do they walk the talk? It's something very important. So we got a lot of ticks when we evaluated Divi's Lab in terms of the management integrity, in terms of their capability, and also in terms of the strategy. So that is how we looked at CRAMS and CDMO business. That is how we figured out these investment trends, and we invested quite significantly in all these companies in the last 3 years. In fact, Divi's has been with us for more than 5 to 6 years now. But because we saw that Divi's has been doing quite well, we started looking at more companies in that sector, and we were able to identify companies like Suven Pharma and Laurus Labs. Incidentally, some of these companies also have a very, very strong domain expertise on chemical synthesis, and which is where they have used those expertise for the large API manufacturing, and trying to create very, very large scale manufacturing base, which helps them economies of scale. And because of their expertise on the chemical synthesis side, they become very, very efficient players. So large API manufacturers, where they are able to create new processes and make it much more efficient, so that the cost of production keeps on going down and they become one of the lowest cost producers, is something what is very helpful. The third segment in the pharma segment that we have identified is that a lot of companies today are fighting in the generic space, but there are very few companies who are actually going in the specialty products. And specialty products, to some extent, is almost like a patented product in the developed markets, be it US, be it Japan, be it some of the European markets. So where they are able to do this, companies like, say, Sun Pharma, they've almost invested $1 billion in the last 5-6 years for the specialty business. A company which is a very small company, Suven Pharma, or now it's renamed as Suven Life Science, the promoter has given his 100%, for this basic research and development. It's just a matter of time that the luck will come to him and he will get his own success. But he has almost dedicated more than 3 decades of his life. He has invested heavy sums of money, which got generated from his other CRAMS business. So the CRAMS business was funding his R&D business. And now that he has got in pipe almost 3 or 4 products on his basic research, he has also started, he has created 2 separate companies, because now he's quite confident that over a period of time, he will be able to generate cash from his R&D company itself. So these are some of the trends on the pharma side, is what we had evaluated. Now, the second is real estate. If I go back to say 6, 7, 8 years back, say in about 2006, 2007, 2008, the real fancy in the stock markets was for the real estate companies. But most of these real estate companies were actually the residential real estate companies. And when we evaluated some of these companies, they were not fitting in some of our construct. So either they did not have the right track record, or they did not have a national region kind of scalability because they were some of them very regional plays, or in terms of profitability, again, not so great. And most importantly, the strategy in terms of the management strategy, which was the most put off. Like, for example, most of these promoters were just buying land. Like they bought, I don't know, a few hundreds of acres of land, each of them, and which they, I don't think they had any vision in how much time frame will they be able to capitalize on this, in the sense how quickly they will be able to build on this land and sell the apartments to the house seekers. So from that perspective, I think in fact, actually, if I can use the word, they almost behaved like jagirdars. So, as if, but you are working for a public limited company, so you can have a 5-year kind of a plan where you can have that kind of land bank and then you build and grow over time. But that was not the thought process that they had. So, but silently what we saw is that in the year 2008, 9, 10, some of the large foreign private equity investors had started investing in the commercial real estate. And that is one of the trends that we started picking up, that they were very happy investing in commercial real estate where they were getting about 9%, 10% kind of yields. And when they, and in fact, they almost committed $2 billion, each of them, like GIC invested $2 billion in a span of 3-4 years. I think even BlackRock invested. In fact, as on today, in the last 7-8 years, all the private equity investors put together, all the global private equity investors have put together, invested almost $14 billion in the commercial real estate. And as on today, they are very happy even getting about 7%, 7.5% kind of rental yields. So that was another trend that we picked up, that this is because as the third point is that as the interest rates actually go down, the value of your rental income actually keeps on increasing, because the rental income grows, but the interest rate goes down. So the valuation, the capitalization rates are much better. That was another very interesting point. I think this global private equity investors could see, because they could see that global interest rates, at least they anticipated that the global interest rates are going to go down. And from that perspective, it made a lot of sense for them to invest in assets which are yielding them today 10%, 11%, kind of yields. Another very important trend that also came up was REITs. Now, REITs has always been a very large global market and very efficient for investors. So from that perspective, we said we need to look at some of the commercial real estate companies. And one of the companies that we could identify was Nesco. I remember in the year about 2009, when I met this company, in terms of track record, it had cleaned up its balance sheet. It had become debt-free. They had almost 50 crores of profit at that point in time. In terms of scalability, they had not even scratched the surface for the kind of the land they have, because they have nearly 65 acres of land in the heart of Mumbai, and they had plans to build IT parks over there. In terms of the profitability, it was very decent when you look at the rental incomes, kind of the rents that the Mumbai commercial real estate yields and the kind of the construction cost, because they already had land. So they just had to spend for the construction cost and the rental income. If you see, the profitability was almost 20-30% at that point in time for them. In terms of the management, the best thing that I liked about was the strategy. I asked them, what's your plan going on from here on in the year 2009? And the management told me two things. We have two plans. First is we will never take debt. That's point number one. And point number two, they said that whatever cash flows that we generate from our existing business, which is the exhibition center and some bit of the IT park that they had at that point in time, we will reinvest all that money to build more IT parks and generate even a larger pool of rental income. This was 2009. Today we are in 2020. It's 11 years. And the management has exactly walked the talk. And even today they have only this 2-line strategy. And if you see today, they are already a 300 to 400 kind of a rental income. They have profits, which is March 20 declared of almost 200 crores. If I add to the one new more IT park that they have already started, I think the profits will go to 300 to 350 crores in the post-COVID environment. And today they continue to be debt free. Not only debt free, but they have nearly 600 crores of cash on balance sheet. So this is how we look at it, and this is where we've made our pick on the real estate. We looked at annuity rental incomes compared to the land bank NAV kind of valuations. Now, automobiles. This is one sector which we all understand. We know it has a very large potential. Looking at the demographics of the country, the kind of the population that we have. In fact, in terms of the penetration, we are the lowest probably among the world, right? But yet, this industry goes through a lot of cycles, and it's very, very cyclical. It has deep cycles. So what we said is that if we invest in the pure local OE players, OE's original equipment, which is the Marutis and the heroes of the world, they all will have the cycles. We have seen this in the last 20 years, at least that I have seen. And each segment, whether it's passenger vehicle, whether it's two-wheelers, commercial vehicles are even more cyclical. So, that was a challenge over there. If we look at the auto ancillary businesses, the biggest challenge is that not too many auto ancillaries have been able to scale up the business. And the second part has been that, there is very low profitability, because auto ancillaries are always at the mercy of the OEs. Because when they supply to some of these original equipment manufacturers, the bargaining power that they have is very limited. So the profitability is also very low. So what we said is that we should look at companies that not only serve the Indian market, but also the global markets, right? So that is where the term the global comes into the play. So we identified companies like, say, Sundaram Fasteners, where almost 30 to 40% of their revenue is exports, largely the US markets. We identified Timken India, where 75% of its business comes from exports, industrials, and railways. So the pure auto will be just 25%, which is not a bad thing for a bearing company. We also looked at Eicher Motors. Now, this company has been largely domestic, the Royal Enfield bikes. But if you see in the last 2 years, the management focus has been significant on the global markets. The key management person, which is Mr. Lal, who actually built Royal Enfield in the new avatar in the last 10 years, where, we all know Royal Enfield has become a household name today. He has shifted his focus, his personal focus completely to the global markets. And he's already got some success. So that is how we selected Eicher Motors also over some of the other, local OE players. The other very important thing, as I mentioned, about the profitability. So if you see the companies that we have selected, Sundaram Fasteners has got a profitability at an OPM of about 20%, operating margin of about 20%. Timken also similar, and Eicher Motors actually about 25 to 30%. But we have to understand that this operating profit is only possible if the gross margins are higher. So Sundaram Fasteners has a gross margin of almost 60%. Same does Timken have about 60%. And this is where it shows that the kind of the value addition that these businesses do. And that's why they are, in spite of them being suppliers to some of the large OEs do appreciate that, and they allow them to make this kind of money. The other very important thing is the scalability of the business. Eicher Motors today it sells just about maybe 8 lakhs, 9 lakhs, maximum in the best case scenario, they'll probably sell about 10 lakh bikes in the next year, or that's been their peak kind of a thing, in a total, 2 crore bike market, right? But if you see the profits that they make is almost 60% of the market leader. So that's how what we also look at the scalability. Sundaram Fasteners is already a $500 million company. The vision of the management is to quickly take it to $1 billion. But if I know them well, I don't think they are going to stop at anything less than $2 billion. That's the fire, that's the hunger that they have, to grow the business. And they have all the impediments for them to take them to that level, whether it's the track record of their business, like Sundaram Fasteners is more than a 40-50-year-old company, amazing track record in terms of the, it's one of the few companies that I know in this country which has not had any labor strike in the last 50 years of their history. So that speaks of the pedigree of the management, right? So that's about autos. Now, another very interesting thing, we all know that India, the consumption is is rising very, very rapidly. And from that perspective, investing in the consumption theme is very, very important. But most of the traditional companies, which are the FMCG companies, have been trading at very, very high valuation. So in our construct, they wouldn't probably fit in the valuation part of the whole thing. But then when we looked at a little more deeper, we saw that some of the lifestyle consumptions is also a new trend that's emerging. So be it travel for leisure, be it on the healthcare side, or the new, I would say probably oxygen, which is the data. Today, I think it's taken a shape which is above roti, kapda, and makan also. So data is something which is the digital revolution at the consumer end. I think that's a very important thing which is playing out. So how did we play out, or how have we invested in some of these trends? I'll share that. So when we looked at the travel trend, what we realized is that most of the upper middle class families, have started taking more than one breaks a year. It's in fact almost went to 2 or 3 breaks every year when it came to their leisure vacations. Now with that trend, obviously one of the best plays was hotels. But when we look at most of the hotels, they do not actually have the right construct, in the sense that hotels is a very, very cyclical business. It's a very asset heavy business. They do not have the right inherent profitability with most of them. So these are serious challenges with hotel businesses. But then when we looked at this company called Mahindra Holidays, it's a absolutely unique business model. Here the company doesn't have to invest for its growth. Its customers, the customers of the company, which is the members of the Mahindra Holidays, they fund them to build the new resorts for themselves. So the company over here has actually invested, company has actually built almost 3,500 rooms in the last 20 years of its existence, with almost no capital invested from its own balance sheet. All the money that they have invested is from the money that they would have collected from their customers, right? And that's why they generate huge amount of free cash flow. Of course, there were some challenges post the IPO times. And as I said, that when we invest in businesses, we've been watching the track record for a while, and we just don't jump into it. And we knew the problems that they were created from 2009 till 2013-14. But sometime around 2013-14, the management acknowledged those challenges. They actually corrected the course. And also at the same time, what they did is they started completely re-strategizing and going back to their customers and working very, very strongly on that. And now the proof of the pudding is, as we can see, that today they had their cash balance of less than 50 crores in sometime 2014. And today they are almost at 800 crores of cash on their balance sheet. So this is a very unique business model that we are participating in for the travel trend. When I also look at the healthcare side, today one of the very important things is that for most of the families, the maximum amount of incremental spending that happens is on the education and the healthcare side. So on the healthcare side, we looked at hospitals, because today in India, the potential, today, if we look at, we all understand the COVID, we all are completely exposed. Our healthcare system has got completely exposed, how under invested we are in it. With this COVID, we all know the kind of the shortages of the hospital beds that we all are facing. So we said that this is where the potential is very large. And one of the reasons why people are not able to spend is because they don't have insurance. So as the penetration of insurance increases, the need for the hospital beds is going to increase. The need for the healthcare is going to increase. So that is where we identified the company Narayana Hrudayalaya. And it did, again, it had a very differentiated business model compared to other hospitals. Like, for example, they were actually having they did a relatively asset-light model as compared to the others, in the sense that most of the other hospitals were owning their own land, they were building their own buildings, Whereas Narayana Rudalaya actually went on the lease model or went with partnership with some other investors, and they were only managing the hospitals and the equipments. So that not only helped them create efficiency in terms of the profitability, but it also kept them under leveraged, which is a very important thing when one is running a business to maintain the risk capacity or the risk management. Similarly, with HDFC Life, all these years before it was privatized, when we were all having LIC only, I think it was largely utilized as a savings product rather than an insurance product. After privatization, again, ULIP took a very big thing, and that's why again it became more of a savings product rather than an insurance product. But HDFC Life has been innovative. They were always very focused on offering very, very specialized pure insurance products, be it term insurance or some of those products. And the other important thing is to sell insurance to such a large country of almost 120 crores, you need a very wide distribution network. And because of their parentage, HDFC Bank is one of the big, they have a bank insurance, but that's a bankable bank. A lot of banks, would like to sell non-banking products, but they are not successful. HDFC Bank has been at the top of the charts, be it selling mutual funds to their customers, be it selling insurance to their customers, or any of the other non-banking services. HDFC Bank has been at the top of the charts, and that is where HDFC Life has been very, very successful. And another very important thing about HDFC Life is the culture of the group. They are extremely, extremely focused about their profitable growth. So and with the right risk. So keeping the risk management in play and making profits is something which is inherent to the HDFC culture. We have seen with HDFC Limited, we have seen with HDFC Bank, now we are seeing with HDFC Life, we have seen also with HDFC AMC. So that is also very important. On the data, on the consumer digital revolution side, I think we all know, when I look all around, whether it is my security guard, whether it is the office boys, whether it is the chauffeur, I think if we keep a meal for them, they'll be fine as long as the data is going on. As long as they are watching their movie in their idle time or most of the time, I think they are very happy. And now that this integration is happening for the entertainment, for retail, so we moved from telecom to retail to entertainment, everything. And from that perspective, this is a very, very large revolution. Simultaneously, we have seen the entire industry going through a huge consolidation phase. We are now left with 3 players, with 2 players being very profitable. And from that perspective, I think this is also a very interesting play for the next at least 3 to 5 years. We strongly believe that both these companies, with Reliance Jio and Bharti Airtel, will continue to do very well with the consumers queuing up just to use data as if there is nothing else in this world. IT services, we all know, has been one of the biggest wealth creators for most of the investors in the last few years. But somewhere IT also has become a commoditized services. We said, let's focus on some of the other new emerging trends. So we identified all the future technologies. So we identified a company called Tata Elxsi, which has been extremely focused on embedded software, and they have identified 3 sectors, which is auto, media, and healthcare. So within auto also, their large focus is with autonomous vehicles, commercial cars, EVs, which is the future of the automobile industry. Within media, OTT platforms is where they were always focused on. I can't even say it's the future because it's already now live. Everybody is now on Netflix and the Amazons of the world. We all are consuming all the content largely on the OTT platforms. So that's another very big trend. And on the healthcare side also, particularly now with COVID and otherwise also, I think even pre-COVID, we have seen a lot of medical devices where there was a lot of operations happening on the remote side. So even that's been a very big trend, and which is where companies like Tata Elxsi should benefit in a significant way. Now, infrastructure has been one of the most important opportunities for this country. In fact, I think it's almost like an unavoidable opportunity because as a country, we are completely starved of infrastructure. We need better roads, we need better highways, we need better ports, we need better airports. I mean, we need, I think, even better railway stations. But there are very few companies which have actually created wealth for themselves. As a company, they have not grown so large in terms of the profitability, or whichever way you look at it, they have not done anything great. And even for shareholders, not too many companies have created wealth, and simply because most of them miss this construct of having the scalability, or having the profitability or the cash flows in place, right? So the company that we identified is a Gujarat Pipavav Port. Now this company is probably one of the few infrastructure companies in the country which is debt free. Not only that, they have a free cash flow. Not only that, whatever profits that they make, they actually pay out fully. So they have really created an asset where they understand how efficiently they have been able to do it. And it is owned by a multinational company, which is APM Maersk, which is the largest shipping line in the country. So in terms of management quality also, most of the ticks are there.
So Sachin, hi, sorry to interject. We will, can we conclude the presentation part quickly so that we can take a few questions? So we have also done a few polls while you were speaking. So I've got some interesting insights to share from the poll as well.
Sure. So actually, Sanketo, I just have probably one or two more trends to talk about, and then I'll just conclude.
Sure.
Yeah, I'll run through that. Sure. Yeah. So this is the, I think another very important thing is the export side, because, all said and done, every business goes through a cycle. Similarly, every country has its own cycle. So de-risking our portfolios from the country's cyclical GDP growth is also very, very important. In fact, some of the sectors that I mentioned, pharma sector, IT sector, even the auto and automobile ancillary, which are export oriented, they all have exports inbuilt, and that is where it really helps us. We've also invested in a couple of niche plays, which is a coffee manufacturer, which is CCL Products, a chemical outsourcing company, which is Navin Fluorine. So these are some of the businesses that we have also invested in. I think in the interest of time, I will hold on myself over here, and over to you, Sankar.
Sure. So let me just share a few insights. While you were talking, we conducted a few quick polls. And the last question that I asked to the audience was if they have added health insurance cover in the last few months. 55% of them said yes, while 44% said no. So another interesting, poll that we had while you was live was we asked audiences where they want to invest in the next 10 years, from large cap Indian equities, small cap equities, multi cap equities, or global equities. So 42% said they want to invest in multi cap equities, and a striking 11% said they want to look at global equities, read US equities. Interestingly, amongst the trends that we think, are that the audience thinks is going to be strong for the next 10 years, information technology, 39% of the audience feels is going to do well. Surprisingly, BFSI and FMCG, which were the darlings, only 10% people feel that they will do, well in the next decade. But that's for time to say. So, we had a very insightful discussion. You explained a lot of things. So, what my first question to you is going to be, back in the days of 2008-9, since you've mentioned a lot of those days, I bought a product called Microsoft Zune. I'm sure most of the people on the call don't even remember what the product was. So this was an iPod competitor, and the trend was heavy for iPods then. So what my point is, if what doesn't trend, gets beaten very badly. And if you had bet on Zune doing well, you would have been hurt. So the question is, how do you choose trends, or you spend some time on explaining trends that have done well, that you think will do well. The question to you is, how do you choose a trend? How do you build that conviction around the trend? Maybe take some time and explain to us.
Thank you, Sankarpur. I think that's a very, very interesting question. So the key thing is that is where our research comes into play. And when I talk about research, it includes multiple things, So, for example, I spoke about that we looked at the pharma trend, which is the CDMO trend, right? So one of the important things which I had learned from someone is that when you work in a large company, you should always keep your eyes and ears open. Now, I've been with Emkay Global for almost 9-10 years now. And MK Global actually has a very large R&D, large research unit for their MK Global broking business. So this is about 4 years back or 3.5 years back. I was interacting with our pharma analyst, and we were just discussing that if the US generics market is a challenge, this is a challenge, and even the domestic formulations market at that point in time was not growing very aggressively. It was in low single digits. So we said, where is the opportunity? And that's when we talked about the CDMO. And then we started deep diving it. Then we looked at companies like BV's Lab because we were already invested and we understood some of the trends, right? So, you have to keep your eyes and ears open and you will get a lot of cues. And that is where the research comes into play. For example, I mentioned, sometimes also interacting with a lot of our companies gives us those inflection points. Like, for example, when I invested in BV's Lab, they were doing very well and all of that. But we increased our bet significantly almost around 3 or 4 years back, actually 3 years back, because, in our interaction with the management at the AGMs, what we realize is that the management is now planning to invest in terms of new capex, almost rupees 1200 to 1400 crores. Now, if I look at the history, in the last 6-7 years, they had invested less than 1000 crores. And now the management is talking about investing another 12 to 1400 crores in the next 2 years, right? So obviously this management has been very, very prudent. They have created this kind of ROEs and ROCs. And if they are thinking of investing 1200 to 1400 crores, there is clearly a very big trend that is going to play out for these businesses as we go ahead. Or as I mentioned about the real estate companies, there was a clear trend where the large global private equity investors were committing billions of dollars to this business. So this kind of trends, one will have to keep their eyes and ears open. One will have to keep on reading a lot and do a lot of, and this is actually what research is all about. Research is not about, you picking up an annual report today, understanding and just going and invest. No, it's about, as I mentioned about the trend, about when you look around, that kind of the traveling, the leisure trends are happening. So as you deep dive more into it, you will realize that this is a trend which is picking up all around.
Okay, so the basic is that you try to keep your ears and eyes on the ground and see what are businesses that could be trending.
Right,
okay, that's a very interesting take, and I'm sure MK, the group, is quite handy there. So the next question that I want to ask you is, like a part of my previous question said, trends hurt if they go the other way. So what could be a possible, like I'm sure investors on this call would want to know that what could be the pitfalls of trying to spot a trend, or the red flags that if you get a trend wrong, just to say, a lot of people would have expected companies like media companies which are listed on the browsers, there are very few of them, to do well. However, I'm sure even when COVID came in and people are confined to their homes, I don't think there's a lot of traction there, despite a lot of being a lot of entertainment shifting to these platforms. This is just one example. How do you think this can be detrimental or a red flag, like I said, while looking at trends?
Yeah, that's also very interesting. See, the key thing is that these trends don't emerge overnight. These trends will always evolve over a period of time. And that's why the markets will give you enough opportunity, enough time to build on it, right? So that's the first thing, that they will always evolve. And as you know, as you keep on walking towards time, as the trends keep on building, you will keep on getting more and more confirmations, right? So as I said, for example, like the real estate trend that I spoke about. So it started with the foreign investors investing in the money. Then we talked about the interest rates going down. That was the second trend. Then the third is about the REITs coming into the play, right? So there were many parameters which come into play, and that is how the trends or a broader trend gets emerged. Also, we have to understand that parallelly, when I'm looking at the trends, I am not giving up on my basic constructs. The companies that I'm investing in, they will have those constructs. So even if the trends probably don't emerge, my margin of safety, my safety net is going to be always there, because the business construct is very much there. Those companies have a good track record, good management quality, they have all of it. So what will happen? You will make a normal return, you will not make an exceptional return if the trend doesn't emerge, because they will always be in much better performing companies within their sector. But if the tailwind of the sector doesn't come, they will grow probably less than otherwise they would have grown if the tailwind was there.
Right. So the next question, which in fact while you were answering, I was thinking in my mind is, so Aristotle is one of my favorite philosophers. He said, what we do repeatedly is what makes us. You've been managing money for 20, 25 years now, 9 years with MK. You mentioned a philosophy called E-Qual. Okay, so you just brushed by it. So since you do this day in and day out, it's part of your DNA. It's part of who you are. So I think the audience is interested in knowing trends, but also this is one important aspect to the trend. So your philosophy or how you look at it. So please take some time and explain to us what E-Qual is, or what it has developed over the years with your learning. Over to you.
Sure, Sankalp. So this is, thank you. Actually, I'm thankful to you because this is, I have a couple of slides on this, which I thought in the paucity of time I did not share. But now since you've asked, probably I will take that liberty and talk about it. So it's much easier for everyone to grasp on it. So basically, E-Qual risk is a model, which is MK qualitative risk analysis. What we said is that, management quality, we all like to say it has to be very good. The pedigree has to be great, all of this. But management quality effectively is actually becoming a very subjective thing. Like for example, two of us would go and meet a management will talk everything that is music to our ears, right? But once we come out, I will say, wow, this is great, this is superb, they are going to do great. And you will say, oh, he was bullshitting. How do we know what he's saying is right or wrong? All of that. So how do we actually make this entire exercise very objective to get the subjectivity out? So what we said is that we should look at the, what are the action points? Whatever management is saying is fine, but are they walking the talk? What has been their actions in the past will actually tell us how credible they are. So I will tell you one of the modules that we have created, and I will share that on the screen. Just 1 second.
Sure.
Yeah. Yeah, Sankalp, are you able to see the screen?
Yes. I can see the screen. Maybe you can just go into slide mode. Yeah.
Sure. Okay. Yeah. So, this is what our basic construct is for the whole thing. So we said when I want to evaluate management quality, I would like to look at 4 or 5 basic points. So look at management integrity. Are they honest enough? Capability. Are they efficient enough? Also in terms of wealth distribution, do they share the wealth with the minority shareholder? That's also very critical. Investor communication, because our job is to do research. So unless we get the right information from the companies, I will not be able to do the right analysis. So I need investor communication is also very important and critical. And then of course also liquidity, because if I have to participate, I need enough liquidity in the stocks to invest in. So this is something where we evaluate management quality. I will just talk a little bit more. So for example, now management integrity. We all talk about that we would like to have honest management. Now, how do I decide who is honest and who is dishonest? I don't want to have any prejudices or any biases towards anything. So we said we'll look at action points. We will look at data which is publicly available for all companies. So there's an apple-to-apple comparison, right? So we said look at promoter holding. The idea is that higher the promoter holding, lower the probability that they will do something silly, because they have enough amount of skin in the game, right? So what we have done is say, this is our own subjective thing, but what we said is say, if I, in my entire construct of 100%, for promoter holding, if I give 7.5% weightage, now today SEBI's maximum shareholding allowed is say 75%. So every management which probably owns maybe 65-70% plus, I will give full 7.5% marks. If a management has about 50 to 70%, I will give probably 5% weightage. If they're between 30 to 50%, I'll give probably 2.5%. If they're below 30%, I will not give them any marks, right? At the same time, has the promoter holding increased or decreased? If they have been increasing the shareholding, I will give probably positive marks. If they have decreased, I'll give negative marks. Another very important thing is promoter group salary as a percentage of profits. You talked about the media companies. The problem with the media companies has been that with most of the large media companies, the construct has not been there. The cash flows has been wrong. Or in fact, one of the large media companies I know, at least till 5 or 7 years back, the husband and the wife, both of them put together, were drawing a salary of more than 200 crores when the profits were under 500 crores. Almost 30-40% of the profits, or maybe 25-30% of the profits were going to promoter's salary. Now, up to 5%, up to 7%, up to 10% is acceptable of the total profits. But anything beyond 10%, is something that we do not like. So this is, or who are your auditors? That's another very way to look at it. Are they among the big four? Are they among the known auditors, or are they among the unknown auditors? So these are some of the pointers which really help us evaluate companies in a very, very objective way. That's how we look at it. Now, if you look at the management capability, which is another very important thing of how efficient the management is, because just being honest is not enough. You also need people who are smart, right? They have to finally, at the end of the day, make money and create wealth for all the stakeholders. So that's also very important. So how well have they managed the debt equity ratio? Because when the business went down, like an environment like this, there were for 2 or 3 months businesses did not have any business. There were no revenue, there was no sales, there were only costs. How have the companies managed? I think companies which will emerge stronger out from here, they are going to go a very long way. When they do capex, how capital cost efficiency they are? Are they able to finish their projects within the time, within the budgets, or they have a lot of cost overruns, time overruns? That also plays an important role. So these are some of the very important things that we follow, when it comes to equal risk. I hope I am able to address what you were looking for.
Right. So we have an understanding of what your equal, the property, equal framework is. So I did an interesting poll in the meanwhile. I asked, how many people have visited at least once the website of the stock they have bought. Interestingly, 20% haven't, but I'm happy 80% of the people have at least visited the website of the stock they bought. So that shows that as an investor community we are evolving, and I hope we get better in the coming days. We get more informed. So another question that that I want to ask is, Sachin, you remember we were discussing tennis before the call, and you said you like underdogs when I asked you about Federer and Nadal. So that brings me to an interesting question of valuations. Okay, so how do you look at valuations? You just touched through, but a lot of people interestingly ask this question because सबको लगा था कि कोविड के बाद एक मंदी आएगी, काफी लंबी मंदी, गहरी मंदी चलेगी, but it happened otherwise. So with that, what's your view on valuation when you construct a portfolio and when you spot trend? Because in my understanding, if a trend is going strong and the conviction builds on, companies are likelier to get even more valuation rich. So if you can just share your thoughts on this.
Sure. So I will talk about that in a bit, but on a lighter note, you said it happened otherwise, but let me say for sure, we are not complaining. Right. So on the valuation front, of course, there will be different business models or different industries will have different valuations. But as a general thing, okay, as a very thumb rule kind of a thing, the way I look at it is that when I value companies, there are three we generally most of the time we look at the P ratios, right? But how do you decide what P is right and what P is wrong, right? So P ratio standalone to my mind has no meaning. It has to be looked in the context. And what are these contexts? So I look at three very important parameters whenever I want to assign a P valuation to a particular business, right? And these three contexts are: first is growth. What is my growth outlook for the next 2, 3, 4 years? That's the first parameter. Second is, what is the ROE? What is the return on equity that the company generates? That's also very important. And let me tell you, growth is dependent on ROE. You can't have too much of growth without a decent ROE. That's almost certain, unless you are doing something very disruptive. And the third is the size of the company, because the size also matters. The smaller you are, the more vulnerable you are to the external challenges, say like COVID, you are very vulnerable to the external challenges. But the bigger you are, you can really withhold a lot of storms. So if you are a larger in size, you will command a better premium in P valuations. If you have a better ROE, you will again have a better premium valuations. And if you have a high growth, that will definitely help you get much better Ps. Because, again, I will tell you, when I mentioned these three, the weightage to each of them is very different. It's not equal weightage. There will be a very high weight to the growth, which is almost probably maybe 60-65%. To the ROEs, I'll probably assign about 20-25%. And to size also maybe another 5 to 15%. So these are three very important parameters that I really focus on when I have to assign a valuation. And, because when we talk about P, I'll just take one more minute. Because when we talk about P, what does it mean? If I say a stock is 20P, if you think about it, effectively it means that today I'm earning 100 rupees. The stock is trading 2000 rupees. So it's a P of 20. So if I continue to 100 rupees every year, my payback will be 20 years. Right? That 20P effectively means that if there is no growth in your earnings, the payback for you will be about 20 years. Right? But when you assign a growth to your 100 rupees, suppose 100 will go to 120, 130, 140, your payback will be much less than 20 years because your 2000 you will reach much before the 20 years. Now, when you have a higher growth, it could be 10 years, it could be 7 years, it could be 5 years. So higher the growth, quicker the payback, better I don't mind paying the higher P. When I am happy with a 7-year payback, I will assign that kind of a P. So that's how I look at valuations.
So you are from the Newtonian school of thought that nothing is ever devoid of relativity. Good. So that's an important insight because different people have different takes on valuation. It's always interesting to know. So this is probably the last two questions that I'm going to ask you. So one is a more first, if you can answer this, what offerings does Emkay as a house have for its investors? What kind of products Emkay has, and who do you think is suitable to invest in these products? And the last question that I want you to take, and we'll conclude there, is what has been your personal learning? Because at the starting of the session, you said that investing is an art and science. We will leave science for some other day. Let's talk about art. And I believe wo art hi kya jisme commerce nahi. So, how have you mastered this art, and what has been your biggest learning lessons from being an investor in the Indian capital markets? So over to you, these two questions, and we conclude there.
Sure, thank you. So first thing, let me tell you that at Emkay, we have now evolved quite well in terms of our product offerings to the investors. So we have created two partitions. We have something what we call is a classical alpha strategy, and then we have a smart alpha strategy. So when I talk about classical alpha strategy, it's about bottoms up picking. It's about investing, across businesses where we see growth, finding trends, those kind of things. And when I talk about smart alpha investing, it's more about product factor based investing. It's about investing in the right pedigree of the businesses, management, the kind of the track record that they would have, and you have an equal weighted kind of a portfolio over there. So it's more about passive investing, but in an active way, right? So that is our smart alpha strategy, which is where we have two products, Emkay Lead and Emkay 12. On the Emkay classical strategy, we have Emkay Capital Builder, which has been our flagship product for a while now. And then we also have an AIF, which is Emkay Emerging Stars Fund, which is a small cap fund, which we've been running for almost 2.5 years now. So this is largely how we have structured ourselves, and we believe that both these products have a very, very niche offering for the profile of the investors, depending on each of them. And I think the second part, you asked me about my learnings, my art. So Sandeep, let me be very honest with you that there is one of the big things when I joined Probity Research, which is when with Mr. Nirmal Jain, and there was a gentleman called Mr. Bharat Paraje. A lot of people in the markets would know him very well, and I respect him very well. there was a group of us were sitting there, and somebody asked him that how does this badla work? In those days, this current futures, it used to be known as badla. So he tried to somebody else actually tried to explain that person for 1 minute, and then that guy couldn't grasp it. So Bharat said, "Don't worry, I know how you have to learn it." He said, "You first do one trade in badla. Then next day there will be a debit note. You will have to pay the loss for it. And that's how you will become a master of what is badla." So the point I'm trying to make is that everything that we have learned is by paying price. So the equal risk module that I have, that we have created is actually all the mistakes that we have done in our investing in different stocks. So when we realize that this was the mistake and we don't want to repeat it, right? So it became a part of our checklist. So that is where the learning has been.
Right. So you say that you've learned through you've mastered your art by constantly evolving and learning. Well, that's a lesson for all of us. So just two trivia things before we end today's session. So I asked on the poll that Nifty 13,000 by Diwali. 44% people feel yes, and the other rest are not quite convinced. Also, we asked on the poll, is investing in art or science? 58% people say art, I think, and close to 40% people say that it's an art. So it's been a pleasure hosting you, Mr. Sachin, and I think we've learned a lot about how you invest, and our philosophy at as a wealth manager at PMS AIF World has always been that we try to help investors make informed investments. And I'm happy today that we could have you with us to share your thoughts, your perspective. And I will leave investors with the thought that trends are not just mere trends in their literal meaning in investing, but they have a lot of other manifestations. Also, no stock discussed today in any format should be construed as an advice. And we'll see each other in a lot of other our sessions. Thank you everybody for taking your time out today. Hoping to see you at the next time. Thank you, Sachin.
Thank you, Sankalpo. Thank you so much. It's been an ultimate pleasure. Thank you so much, everyone. Thank you for your support. Thank you.
Thank you.